Hi, Assalamualaikum and a very good morning. I bid to Sir Adnan bin Zainal Abidin. Today, our group Mulan will be presenting our group project 2 for course code FAR695. So, without further ado, let me introduce to you our group members. Our group consists of 3 members, which are Nurul Atika binti Muhammad Halimi, Nur Shara Najwa binti Abdullah, and me myself, Nurul Adila binti Abdul Rashid. Next, I will start the presentation by explaining about the two concepts of capital in the financial framework. Under IASB conceptual framework, there are two concepts of capital, which are financial concept of capital and physical concept of capital. Firstly, financial concept of capital is one whereby capital is linked to the net assets or equity of an entity. The net assets is assets minus liabilities, which equals to equity. Secondly, physical concept of capital is where capital is linked to the productive capacity of the entity, for example, units of output per day. There are two capital maintenance, which are the financial capital maintenance and physical capital maintenance. When the financial concept of capital is used, a profit is earned only if the financial amount of the net assets at the end of the period is greater than the net assets at the beginning of the period, adjusted for any distribution paid to the owners during the period or any equity capital raised. The main concerns of the users of the financial statements is with the maintenance of the financial capital of the entity, which is invested capital or purchasing power of the invested capital. Furthermore, there are also two ways of looking at the financial capital maintenance, which is money financial capital maintenance and real financial capital maintenance. Under money financial capital maintenance, the profit is measured if the closing net assets is greater than the opening net assets, and the net assets in both cases are measured at historical cost. This method does not take into consideration an inflation or the time value of money. On the other hand, under real financial capital maintenance, the entity makes a net profit if the closing assets are greater than the operating net assets, and both figures are measured at current prices. Under physical capital maintenance, when the physical concept of capital is used, a profit is earned only if the physical production capacity at the end of the period is greater than the production capacity at the beginning of the period, adjusted for any distribution paid to the owners during the period or any equity capital raised. The main concerns of the users of the financial statement is with the maintenance of the operating capability of the entity and current value of accounting. For the next slides, I will explain using the real-life example on how companies maintain these capitals. Most entities use the financial maintenance concept as it is the easiest to apply because it uses actual prices for goods rather than making adjustments. Both capital maintenance concepts provide useful information. Moreover, investors prefer to use the financial capital maintenance concept as they are focused on increasing and maximizing the returns they receive on their investments. On the other hand, staff and management may prefer to use physical capital maintenance concept as it allows them to assess the company's ability to maintain its operating capacity. This is very useful for manufacturing business in particular, where management may need to ensure the business can keep producing the same volume of goods efficiently. In this slide, I will give you a scenario. Majestic Berhad was established on 1st January 20X1 with 50,000 ordinary shares at RM1 each. It then buys 50,000 worth of stock which sells during the year for RM55,000. There were no other transactions during the period. At the end of the year, the purchase price of the stock increases to RM53,000. So, the solution is, by using physical capital maintenance, the profit for the reporting period is 2,000, which is RM55,000 minus RM53,000. However, by using financial capital maintenance, the profit for the year is RM5,000. But if the company paid out the RM5,000 profit to shareholders, it would not be able to buy the same stock again, as the purchase price has increases. That is all from me. I will now pass the presentation to Atika.
Now, moving on the IASB works on setting the standard for management commentary. Management commentary is the management's discussion and reports that is prepared in accordance with IFRS in order to assist the management in presenting the useful information on the commentary that relates to the financial statements. So as you can see, there are several principles, and frameworks of the management commentary. Firstly, it is to provide the forward-looking information and focusing on what is important to the company's long-term prospects. It is to show the direction of the company and its target to develop the expectation from its past performance and its current states. It also acts as an effective basis for the regulators to enforce the revised practice statement and for auditors to assess the compliance with it. Management commentary also provides management's view of the entity's performance, progress, and position. This is in order to assess the performance and the prospect of the company. Besides, it is to supplement and complement the information presented in the financial statements. For example, the company can provide a narrative explanation on the nature of the deficit when there is a poor return of the plant assets, which therefore the management can use the information to focus on what is important on the plan to take further action as such investment opportunities to improve on the return on asset. And lastly, it must also include qualitative characteristics of the conceptual framework in order to be reliable. Next, the elements of management commentary is based on the fact and circumstances of the business in order to understand the entities better. Firstly, the nature of the business. It is based on the knowledge of the business and the external environment that relates to the entity's operation. Secondly, the management strategies and objective. It is to assess whether the strategies adopted by the entities will be successful in order to meet the objective. The third element is the significant risk, resources, and relationships. It is to determine on the availability of the resources and the ability to transfer the resources to others and whether it can generate inflows from the entity, and the risk that relates to the resource generating that is exposed in the short term as well as long term. Number 4, the results of operation and prospects. It is to understand that the results is whether the entity has delivered its success with its expectation and to know how well the management can understand the entity's market and manage the risk, resources, and relationship of the entities better. And lastly, performance measures and indicators. It is to focus on the critical performance measures and indicators that management use to assess and manage the entity's performance against the stated objective and strategies. As you can see, the presentation of the management commentary is based on these three information. Firstly, it must be consistent with its related financial statement since it is to complement the financial statements. Secondly, it must avoid the duplication of the disclosure in the notes of the financial statements since it's just to provide a further explanation of the financial statement. And lastly, the management commentary must avoid the generic and immaterial disclosures since it is not important to the management's view.
My name is Nur Sharhana Binti Abdullah, and I will continue the presentation with discussion on IASB works on practice statement making materiality judgment. Before we look further, let me first explain what this practice statement is actually for. The objective of this practice statement is to assist management in preparing and presenting the financial information about the entity to the potential stakeholders. This is useful for them to make a better decision for the purpose of making investment or providing resources to the entity. Materiality is a pervasive principle in the preparation of financial statements, considering how the materiality of information could influence the decision of users. This practice statement can also help in making the material judgment to streamline in order for it to work better, which allows lots of entities and users to adopt this practice statement in making a judgment. If the preparers and auditors are able to distinguish on what is material and what is not, the quality of financial statement and information disclosed by the entity could be improved by considering the materiality of an items. This actually shows on why materiality judgment is very important, since this can make the financial statement to be easier to understand. In this practice statement, it includes an outline called 4-step process that could be of help in making materiality judgment regarding measurement and also disclosures in financial statements. By having this 4-step process, many entities will be able to assess the materiality more systematically and accurately. This 4-step process will be explained further later. Okay, now the next one, I'm going to talk about the consideration of IASB in developing this practice statement. Firstly, IASB make this practice statement of materiality judgment as non-mandatory. Thus, the companies applying IFRS standards are not required to comply with this practice statement. The reason on why this practice statement is non-mandatory is because making it mandatory could lead to a risk of appearing prescriptive, making the judgment on materiality by entity to be undermined. Presenting this guidance separately than the standards could emphasize that materiality is pervasive to the financial statements. Besides, IASB developed this as a practice statement since it is more accessible rather than presenting it in educational material, as people can view it publicly without having to get an access to it. This can ensure all the users and preparers of financial statement able to understand and apply this practice statement in making a judgment. As it is also subject to due process, meaning to say it is in accordance to established rules and principles, this can ensure the practice statement can be carried out regularly. Moreover, the practice statement focuses its guidance on preparation of financial statements only, since materiality is widely used for other purposes as well, such as auditors assess materiality in making judgment on completion of audit work done. Having different applications of concept of materiality might create confusion, which will make it harder for users and preparers of financial statements to understand this concept properly in order to make a materiality judgment. This is against the actual purpose of this practice statement. So now I'm going to explain the 4-step process that has been outlined in this practice statement that is useful in assessing materiality. The first step is identify information that might be required by primary users in making decisions or has the potential to be material. This is done by considering the IFRS requirement or disclosures applicable to transactions or any additional information that is needed to understand the impact of transactions or events to financial statements. The second step is assessing whether the information is in fact material. This is a filtering process where it needs to consider both quantitative and qualitative factors, and also by referring to the quantitative materiality threshold. This can help in determining which information are material and which are not. The third step is organize information clearly and in a concise way. This step requires the disclosure to be organized and presented clearly, as to ensure it can be understandable for people to find it useful and helpful in making decisions related to the financial statements. Such disclosures can be organized by emphasizing information that is more material or highlight a relationship between different information to make it more understandable. And for the fourth step, or last step, review the draft of financial statements. The entity should step back and assess whether all material information has been included by reviewing this draft as a whole. This might involve inserting or removing information that is immaterial, thus ensuring the financial statement will be prepared and presented completely. Okay, so in this slide, we include a list of references that we have used in preparing and presenting this topic. Okay, so that is all from our group Mulan. Thank you.